All right. Welcome to the deep dive. You know how this works, right?
Yeah.
You send us the stuff you want to learn about, and we dive in. No surface skimming here. We go deep, so you don't have to.
Exactly. Think of us as your personalized research team. And for this deep dive, you send us a real classic.
We're tackling the intelligent investor. This is Benjamin Graham, often called the father of value investing. This book is packed with principles and strategies, and it's been influencing investors for decades.
And the thing is, even though markets have changed a lot since he first wrote it, the core ideas are surprisingly timeless. Our mission here, well, it's to sift through all that wisdom, connect it to what's happening in the markets right now, and give you, the learner, some practical takeaways.
Okay, so before we get into the nitty-gritty, I think it's helpful to understand a bit about Graham himself. This wasn't just some guy in an ivory tower. I mean, he was right there on Wall Street, and he started young.
Yeah, he started as a clerk right out of college and quickly moved up the ranks. He experienced some, well, incredible successes, but also some really tough losses early on that shaped his whole approach.
You're talking about the Savold tire story, right? That's a pretty wild one.
Oh, yeah. It was 1919, and Graham saw a 250% return on Savold tire stock in a single day. Imagine that.
Talk about a beginner's luck.
Yeah, except turned out to be a total fraud. By October of that same year, the stock was worthless. Talk about a crash landing.
Ouch.
Yeah.
Pretty harsh lesson, especially so early in his career.
Definitely. It really solidified his belief in doing your homework and, not getting swept up in hype. And you see that cautious, research-driven approach play out in another one of his early successes.
Northern Pipeline Company.
That's the one. Around 1925, Graham was digging through those really dry, detailed reports that oil pipelines had to file with, get this, the Interstate Commerce Commission. Not exactly light reading, but he was determined.
Persistence pays off.
Big time. Buried in those reports, he discovered that Northern Pipeline, which was trading at $65 a share at the time, actually held bonds worth at least $80 per share. Hidden treasure.
That's amazing. So he basically found a company that was trading for less than the value of its assets. What did he do?
He saw an opportunity. He bought shares and then started pushing the company to increase its dividend, to reflect that hidden value. And ultimately, it paid off. He ended up making a really nice return.
That story just highlights how important it is to look beyond the surface and not take things at face value.
Right. And that brings us to what Graham really meant by an intelligent investor. He wasn't just talking about smarts, like having a high IQ.
So it's more about temperament, you're saying?
Exactly. It's about having the right mindset and the right habits. He emphasized being patient, disciplined, and always willing to learn. But the most important thing, I think, is that he stressed the ability to control your emotions and think independently.
Okay, let's be real. Controlling your emotions when it comes to money, that's easier said than done.
Totally agree. But Graham was really adamant about this. He saw emotional decision-making as one of the biggest dangers for investors. In fact, he had a pretty strong opinion about enthusiasm, of all things.
Enthusiasm. That sounds almost anti-American.
Well, not exactly. He believed that enthusiasm is a powerful force for good in many areas of life, driving progress and innovation. But on Wall Street, he saw it as a recipe for trouble. Getting caught up in the hype, following the crowd, that's how you make bad decisions.
Especially today, right? It seems like every other week there's a new hot stock or a new trend that everyone's going crazy for.
Yeah, and that's exactly when Graham's advice is most valuable. It's a reminder to step back, take a deep breath, and really think for yourself before jumping on any bandwagon.
So all this is about having the right mindset. But how does this translate into an actual investment plan? Especially for what he called the defensive investor.
Okay, so the defensive investor, as Graham saw it, is someone who wants to grow their wealth steadily over time without taking on too much risk or spending a ton of time managing their investments, their core strategy. Pretty simple, actually. It's dividing your money between high-quality bonds and high-quality stocks. A balanced approach.
Makes sense. But what about the exact split? Like, is there a magic percentage?
Graham didn't give a hard and fast rule, but he did suggest a range. He said you should never have less than 25% or more than 75% of your portfolio in common stocks, with the remainder in bonds. He considered a 50-50 split to be like a comfortable middle ground for most people.
Okay, a good starting point.
Yeah.
But I'm guessing he also acknowledged that the market doesn't just stay flat, right?
Oh, absolutely. He understood that markets go through cycles, they go up, they go down, and he suggested that a smart investor adjust their allocation gradually based on those big swings.
So basically buying more stocks when the market is down and maybe
Yeah.
trimming some when it gets really high. Classic, buy low, sell high, right?
That's the essence of it, but applied not just to individual stocks, but to your entire portfolio. And he made a really interesting point about the emotional benefits of this approach.
Oh, I'm all ears when it comes to managing emotions in investing.
Right. He said that this balanced approach gives the defensive investor like a sense of peace no matter what the market is doing. When the market is up, well, half their portfolio is participating in the gains. And when it's down, they can take comfort knowing they're in a less risky position than someone who's completely invested in stocks.
So a built-in buffer against panic. I like that. Now, I remember Graham also being a big advocate for investing in companies that were trading close to their tangible asset value. Can you remind me why that was so important to him?
Sure. Tangible assets are basically the physical stuff a company owns, things you can touch, buildings, equipment, inventory, minus any debts or liabilities. Graham preferred this kind of concrete value over, let's say, intangible assets like goodwill or brand recognition, which can be harder to measure and can fluctuate a lot.
So more substance, less speculation.
Exactly. He believed that if you buy a company for a price close to its tangible asset value, you have a solid foundation for your investment. You're not relying as much on the market's whims and perceptions, which can be so unpredictable. You're anchored to something real.
It's like focusing on the underlying worth of a business rather than just hoping that the market will magically recognize its potential someday.
Right. Exactly. And this really ties into his strong aversion to speculation. He drew a very clear line between investing, which he saw as a careful analysis of value, and speculating, which was basically trying to guess what the market will do next.
And he wasn't a fan of market timing, was he?
Not at all. He believed that for the average investor, trying to predict those perfect moments to buy and sell is just a losing game.
So how did he reconcile that with the whole buy low, sell high idea? This seems like it requires some timing, doesn't it?
He saw buy low, sell high as more of a reaction to significant price movements that had already happened. Not trying to predict the future, but rather recognizing when a stock had fallen substantially below its intrinsic value and, taking advantage of that. Same thing on the sell side. If a stock has gone way up and you think it's no longer a good value, you might consider selling.
So more about responding to opportunities than trying to be a fortune teller.
Precisely. And he also made this fascinating observation about stock market valuations, almost like a paradox.
Oh, I'm intrigued. Tell me more.
Okay, so he noticed that often the better a company's fundamentals and its future prospects, the less its stock price seems to be tied to its tangible assets, its book value. The price gets more driven by expectations, by what investors believe the company will achieve in the future.
So, in a way, the most successful companies can also be the most volatile because their value rests more on perception than on those hard, tangible assets.
Right. It's a bit counterintuitive, but makes sense when you think about it. The market is always trying to anticipate the future, and that can lead to these big swings in price, especially for companies that are seen as having huge growth potential.
Okay, so in a world where prices are constantly fluctuating, what should the intelligent investor really be focusing on?
Graham believed that investors should view those price swings mainly as opportunities, not reasons to panic or get overly excited. If a good company's stock price drops significantly, that could be a chance to buy at a discount. And if it rises substantially, it might be a good time to sell if you think it's gotten ahead of itself.
But in between those big swings, what should we be doing?
He advised tuning out the daily noise and focusing on the fundamentals. Are the companies you own still performing well? Are they paying consistent dividends? If the answer is yes, then there's no need to get caught up in the day-to-day fluctuations.
Solid advice. Let's switch gears a bit and talk about inflation. That's something that's always on investors' minds. And you hear this advice all the time, right? Buy stocks as a hedge against inflation. What did Graham think about that?
He actually questioned that conventional wisdom. He looked at the historical data, and it showed that stocks didn't necessarily perform well during periods of high inflation.
So not the slam dunk hedge that people think it is.
Right. In fact, his research suggested that stocks could actually struggle in both deflationary environments where prices are falling and in highly inflationary environments where prices are rising very rapidly.
That's interesting. So if stocks aren't always a reliable inflation hedge, what did he recommend?
He mentioned Treasury inflation-protected securities, or TIPS, as a more direct way to protect against inflation. These are bonds where the principal adjusts with changes in the consumer price index. So if inflation goes up, the value of your bond goes up too.
Seems pretty straightforward. Any downsides?
He did point out one potential drawback. The increase in value that you get from inflation is taxable, even if you haven't sold the bond.
Okay, something to consider. Now, what about real estate? That's another asset that people often see as an inflation hedge.
He briefly mentioned real estate investment trusts, or REITs, as a potential hedge, but he also cautioned that if you already own your own home, you already have some exposure to the real estate market.
So maybe not necessary to double down. Let's go back to bonds for a bit.
Yeah.
He talked about different types of bonds, right? What were some of the key points he made?
He emphasized that bonds with shorter maturities, meaning they mature in a shorter period of time, tend to be less sensitive to changes in interest rates, so their prices are more stable. And for investors who are really prioritizing safety, he recommended U.S. savings bonds, specifically Series E and H.
What's so special about those?
They're backed by the full faith and credit of the U.S. government, so they're considered extremely safe. And they offer guaranteed returns. It's like a very conservative way to invest in the debt of the government.
Okay, got it. Now, what about those municipal bonds and those corporate bonds? What did he say about those?
Municipal bonds are those issued by state and local governments, like cities and counties. And their big advantage is that they're generally exempt from federal income tax. But he stressed the importance of checking their credit ratings, to make sure you're buying bonds from issuers that are financially sound.
Makes sense. And corporate bonds?
He was a bit more cautious about corporate bonds, particularly those with lower credit ratings, which we often call high-yield or junk bonds today.
Why was that?
His concern was that for an individual investor, it's tough to diversify adequately within that category. If you only own a few junk bonds and one of them defaults, you could take a big hit. Now, mutual funds that specialize in junk bonds can help with diversification, but he still saw them as carrying more risk than those high-quality government bonds.
So safety first, especially for the defensive investor. He also briefly touched on income bonds and preferred stocks. What were his thoughts there?
He found it a bit strange that preferred stock, which in theory has some advantages, was often seen as less desirable than income bonds.
Why was that?
Historically, preferred stock had gotten a bit of a bad reputation because of its association with railroad bankruptcies. But he felt that this negative perception was a bit irrational, especially when you compare it to income bonds, where the company only has to pay interest if it's profitable.
Okay, so in his view, income bonds were potentially a better deal for both the company and the investor, but preferred stock still had this kind of lingering stigma.
Right. Now, moving on to asset allocation, how you divide your money between stocks and bonds, he had a very specific viewpoint that wasn't necessarily tied to age, which is what you often hear today.
Yeah, the whole subtract your age from 100 to find your stock allocation rule of thumb.
Right. He wasn't a fan of that. He felt that setting your asset allocation should be based on your individual circumstances and your risk tolerance, not just a number based on how old you are. He suggested staying within that 25% to 75% range for stocks, but adjusting it based on your comfort level with risk, your understanding of the market, and the current market conditions.
A more nuanced approach.
Yeah.
Now, we've talked about the emotional side of investing, but I know Graham was really attuned to that. He had a lot to say about how our brains can sometimes work against us.
He did. He recognized that we humans were not always rational, especially when it comes to money. And he highlighted that losses tend to hurt us emotionally much more than gains feel good.
Like losing $100 feels worse than gaining $100 feels good.
Exactly. And this can lead to some really bad decisions, like selling your stocks in a panic when the market drops.
So how do we combat that? Any advice from Graham?
He had a few suggestions. First, he said to focus on the percentage decline rather than just the point drop. A 500-point drop in the Dow might sound scary, but if the market is up 10,000 points overall, it's actually a pretty small percentage decline.
Okay, perspective is important.
Right. And he even went so far as to suggest that maybe, just maybe, the average investor would be better off if stock prices weren't quoted every day.
Oh, that's radical.
Yeah, his thinking was that if we weren't constantly bombarded with those price updates, we'd be less tempted to react emotionally to every little blip.
Okay, interesting thought experiment. Now let's talk about mutual funds. What was Graham's perspective on those?
He took a pretty close look at mutual funds, and he made some interesting observations. First, he found that the funds that had performed really well in the past, they didn't necessarily continue to do so.
So past performance is not a guarantee of future results, as they say.
Right. He also found that on average, actively managed funds where you're paying a manager to pick stocks didn't consistently outperform the market by enough to justify their fees.
those fees can really add up over time.
Exactly. And he noticed that funds that traded frequently buying and selling stocks a lot tended to have lower overall returns. It's that whole idea of trading costs eating into your profits.
So not a glowing endorsement of actively managed funds.
Right. And it's worth noting that Warren Buffett, who was a student of Graham's, has famously advocated for low-cost index funds as a better option for most investors. That aligns with Graham's emphasis on keeping costs down and not trying to outsmart the market.
What about getting investment advice? Graham talked about all kinds of advisors, from friends and family to professional financial planners. What were his key takeaways there?
He stressed that if you're relying on advice, you should either stick to really straightforward conservative investments or have a very deep understanding of and trust in your advisor if you're going to consider more complicated strategies. You shouldn't just blindly follow someone's recommendations, especially when it comes to riskier investments.
He specifically talked about stockbrokers.
Yeah.
Right. What did he say about them?
Yeah. He pointed out that stockbrokers, or customers brokers, as they were called back then, make their money through commissions, so there's a natural incentive for them to encourage trading, which might not always be in the best interest of the client.
So be aware of potential conflicts of interest.
Exactly. And he said if you have a conservative approach, be very clear with your broker about that and don't feel pressured to take their hot tips.
What about those companies that bring new stocks to the market, the underwriters?
He cautioned against blindly trusting them, too. After all, they're in the business of selling those new stocks, so they have a vested interest in making them sound appealing.
It sounds like his overall message was, be skeptical, do your own research, and don't just take someone's word for it.
That's a good summary. He also emphasized the importance of really vetting any financial planner you're thinking of working with. Look at their background, their credentials, any complaints that have been filed against them, and pay attention to the language they use. If they're making a lot of promises or using a lot of jargon, that could be a red flag.
Okay, so how does all this fit together when we're actually analyzing a potential investment? How did Graham approach security analysis?
He explained that for bonds and preferred stocks, the main goal of analysis is to determine their safety. Are you going to get your principal back? Are the interest payments reliable?
And how do you figure that out?
By looking at the company's past earnings record, its capital structure, how much debt it has compared to equity, its working capital, and its asset values. For common stocks, the analysis is a bit more complex, but it still involves looking at the fundamentals, the company's financial strength, its earning stability, its dividend history.
Okay, but he also seemed to have some reservations about relying too heavily on complex mathematical models, didn't he?
He did. He felt that while looking at future growth potential is important, it's easy to get carried away with overly optimistic projections. And he cautioned against relying too much on these fancy formula to determine value. He believed that sometimes simpler arithmetic and basic algebra can be more reliable.
So don't overthink it. Now let's talk about earnings per share. That's a number that investors love to focus on. But Graham pointed out some nuances that we need to be aware of.
Yeah, he talked about how reported earnings per share can sometimes be misleading. For example, things like convertible securities or stock options can dilute earnings, meaning they can reduce the earnings per share even if the company's overall profits are growing.
So it's important to look beyond that headline number.
Right. And he also highlighted the issue of special charges. These are often presented as one-time events that impact earnings, but he encouraged investors to dig deeper and try to figure out if they really are non-recurring or if they might be a sign of underlying problems.
So earnings per share is just one piece of the puzzle, not the whole story.
That's a good way to put it. Now, for those defensive investors who might be interested in picking individual stocks, Graham laid out some pretty specific criteria.
Let's hear them.
Okay, first, diversification is key. He suggested holding at least 10 to 30 different stocks to spread your risk. Second, focus on companies that are financially sound. They should be large, well-established, and have a conservative amount of debt.
Got it. What else?
Earnings stability is important. You want to see a consistent track record of profits, and a long history of dividend payments is another good sign. It suggests that the company is committed to returning value to its shareholders.
Okay, so far so good. But what about the price? How do you know if you're paying a reasonable price for the stock?
That's where his price limitations come in. He suggested that the stock price should not be more than 25 times the average earnings of the past 7 years, and it should also be no more than 1.5 times the company's book value.
And he provided some real-world examples of utility stocks that met these criteria, right?
He did. He looked at utility companies in the Dow Jones Industrial Average and a random selection from the New York Stock Exchange, and he found that many of them satisfied his defensive criteria. They were trading at reasonable valuations, and they often had higher dividend yields than industrial companies.
So even for a defensive investor, there were opportunities to find good individual stocks. But he also had a very practical piece of advice for most defensive investors, didn't he?
Absolutely. He recognized that for many people, the time and effort required to thoroughly research and select individual stocks, according to his rigorous criteria, it might not be feasible.
So what's the alternative?
He suggested that a low-cost, broad market index fund could be a perfectly acceptable and maybe even superior foundation for their stock portfolio. If they still wanted to dabble in individual stocks, he recommended keeping it to a small portion of their overall holdings, maybe around 10%, after establishing that core index fund position.
A sensible approach.
Yeah.
Now, what about those investors who are a bit more adventurous, the ones he called enterprising investors? He had a different set of guidelines for them, right?
Right. The criteria for the enterprising investor were a bit less strict. He was willing to consider companies that maybe didn't have quite as long a track record of earnings or dividend payments, and he was okay with a slightly higher level of debt.
But they still needed to be financially solid.
Absolutely. He was looking for companies with current assets that were at least 1.5 times their current liabilities and total debt that didn't exceed 110% of their net current assets.
Okay, and what about the price?
His price limit for enterprising investors was no more than 120% of the company's net tangible assets.
He also mentioned some specific types of opportunities that might appeal to the enterprising investor, like those bargain issues. What were those?
One type of bargain he really liked was a stock that was selling for less than the company's net working capital alone after subtracting all its liabilities. This means you're essentially getting the company's fixed assets and any brand value for free. And he pointed out that these opportunities can pop up even when the overall market isn't particularly depressed.
It's like finding a dollar bill on the sidewalk.
Right. And then there were the special situations. These were often companies undergoing things like liquidations or reorganizations. These situations can be complex, but if you do your homework, they can offer the potential for significant profits.
Now, I know the book also includes some pretty memorable case studies. Why did Graham include those?
He wanted to show, through real-world examples, how the principles of intelligent investing can protect you from some of the common pitfalls in the market. He highlighted companies like AAA Enterprises, Penn Central, NVF Company, and equity funding.
Yeah, what were the lessons there?
They illustrated the dangers of speculative financing, the risks of excessive debt and aggressive accounting, and the devastating impact of fraud.
He also included a more recent example, the merger of AOL and Time Warner, which happened back in 2000. What was the point of that one?
That merger showed how market hype, in this case, the hype around the internet, can sometimes drive valuations to extremes. AOL, this internet company, had a sky-high price-to-earnings ratio compared to the much larger but more traditional Time Warner, and it just wasn't sustainable.
Okay, so a cautionary tale about not getting swept up in the latest craze.
Exactly. And then he had those fascinating comparisons of pairs of companies where he looked at businesses that were similar in many ways but had vastly different stock market valuations.
I remember that, like Cisco versus Cisco.
Right. One was a high-flying tech darling. The other was a steady food distributor. And his point was that those valuations often had more to do with market perception and investor psychology than with the underlying fundamentals of the businesses.
We've talked about dividends quite a bit, but Graham had some final thoughts on them, and he also addressed the increasingly popular practice of stock buybacks.
He reiterated his view that companies should have a good reason not to pay dividends. He saw consistent dividends as a sign of financial strength and discipline.
And buybacks.
He was a bit more skeptical about buybacks. He pointed out that they can sometimes be used to manipulate stock prices and benefit executives at the expense of long-term shareholders.
Okay, so he preferred dividends as a way for companies to return value to their owners.
Generally speaking, yes. And then, of course, we come to what Graham considered the most important principle of all, the margin of safety.
This is the big one.
Right. He defined it as the difference between the intrinsic value of an investment, what it's really worth, and the price you pay for it. It's that buffer that protects you if your analysis is wrong or if something unexpected happens.
So it's like a built-in cushion.
Exactly. And he believed that even when you're considering more speculative opportunities, like those special situations we talked about, you should always insist on a margin of safety. He even drew an analogy to Pascal's wager, the idea that it's better to believe in God because the potential downside of not believing is so great.
Interesting comparison. So how did Graham's own firm, Graham-Newman Corporation, put these principles into practice? What were some of their strategies?
They used a variety of techniques, including arbitrage, investing in companies undergoing liquidations, using hedges to reduce risk, buying deeply discounted stocks, and taking controlling stakes in undervalued companies.
And of course, there are those legendary super investors of Graham and Doddsville. Who were they and what made them so successful?
They were a group of investors who had all studied under Graham and had consistently outperformed the market by applying his value investing principles. They included people like Warren Buffett, Charlie Munger, and Walter Schloss.
So they weren't just lucky.
No, they were disciplined, patient, and they focused on buying good businesses at good prices. And they always insisted on that margin of safety.
Finally, Graham used a really memorable analogy to describe how the stock market works over different time periods. What was that?
He said that in the short run, the market is like a voting machine, where prices are driven by popularity and sentiment. But in the long run, the market acts more like a weighing machine, reflecting the true underlying value of a company.
So short-term noise versus long-term value.
That's the key takeaway. And he concluded with some thoughts on growth stocks and the increasing use of complex mathematical models in investing. He cautioned against equating promising companies with true growth stocks, and he suggested that sometimes simpler arithmetic can be more reliable than those fancy formulas.
So don't overcomplicate things.
Right. And he reiterated his view that if a common stock is truly a good investment, meaning it's bought with a sufficient margin of safety, it also becomes a good speculation. But he noted that this principle has become less reliable as market enthusiasm has driven prices higher and higher.
Okay, so there's a lot to think about here. The learner, we've covered a lot of ground in this deep dive into the intelligent investor, but hopefully we've given you a solid understanding of the core principles that Graham laid out. And it's amazing how relevant those principles still are today, even though markets have changed so much.
Absolutely. Those fundamental ideas, value investing, a defensive mindset, understanding risk and speculation, and always looking for that margin of safety, they're just as important today as they were when Graham was writing.
And maybe the most important takeaway is that true investment intelligence, as Graham defined it, it's not just about being smart. It's about having the right temperament, being patient, disciplined, thinking for yourself, and most importantly, controlling your emotions.
So, the learner, as you go forward on your investing journey, remember those timeless lessons from Benjamin Graham. And here's a final thought for you. How can you apply these principles of value and safety to your own approach? Could a deeper understanding of these ideas help you build a more resilient and intelligent portfolio, one that's designed for long-term success? We encourage you to keep exploring these concepts and maybe even revisit The Intelligent Investor yourself with fresh eyes.
Thanks for joining us for this deep dive, The Learner.
Until next time.